Hey everyone, Dan here from stocktrades.ca. As we move forward in 2020, you might have some extra contribution room in your tax-free savings account, or you've made some late year contributions to your RRSP. You got some cash sitting in your accounts and you're looking for some dividend stocks to add to your portfolio. We have 5 of the best in the country coming up here. In no particular order, we like all these stocks. They all provide strong dividend growth, long dividend streaks, and moderate to high dividend yields. So let's get started. First stock we're going to talk about is TD Bank, trading under the ticker TD on the TSX. Now, why do we like TD? For one, they have the highest compound annual growth rate out of all the big 5 banks at around 6.05%. And if you don't know what a compound annual growth rate is, it's essentially an easier way to calculate your total investment return over a period of time. You can see here Royal Bank is about 0.75% shy, BMO is well below, and Scotiabank and CIBC come in at the worst. If you factor in these dividends with the compound annual growth rate, you're getting a near 10% annual return on TD Bank, and considering the security you get with this stock being in the Canadian financial institution, a 10% return is pretty good. The company has strong U.S. exposure. They were actually named one of the most convenient banks in the United States. 40% of their revenue comes from the United States, and this does a couple of things. It exposes them to a stronger U.S. dollar, along with the fact that if the Canadian economy is struggling, the United States economy is booming, it's not going to affect the company's top and bottom lines as much. They have strong earnings growth. Again, a compound annual growth rate of around 9.23% on earnings over the last 4 years. They have the strongest dividend growth out of all the big 5 banks. They have double-digit 1-year and 5-year growth rates. I believe their 5-year growth rate is 10%, and their most recent dividend increase was around 11%. If we take a look at the dividend, a little bit of highlights, it yields nearly 4%. It has a payout ratio of around 46%, which is pretty much in line with most of the big 5 banks. I think Royal Bank and BMO are right along that line. They've raised dividends for 8 years. Essentially, all the big 5 banks started raising their dividends after the end of the financial crisis in 2008. And analyst estimates, they have a 1-year price target on the stock of $78.57, and at the time of this video, that implies around 6% upside. Out of 17 analysts, 7 rate the company a buy and 10% a hold, 10 people a hold, and I would say right now that's primarily because of the hesitance towards the Canadian economy right now. If we look at the stock highlights, it's obviously in the banking industry. We would be buying this stock for the income. You're going to get a little bit of growth out of these, as you can tell, 6% over the last 5 years, but their dividends are really why you want to be looking at these stocks. Forward price to earnings of just under 11, price to book of 1.64, a PEG or price to earnings to growth ratio of 1.46. It's pretty typical to see income stocks trading at somewhat of a premium just because of their dividends. The company generates a significant amount of operating cash flows. Over the last 12 months, it comes in at around $52 billion. And their dividend rate is obviously 2.96, and this is what you would earn on a single share over the course of the year moving forward. Second stock we're going to be going over is one of Canada's biggest oil and gas companies, and that's Canadian Natural Resources. Right now, Canadian Natural Resources taking advantage of a weak oil and gas sector. They purchased Shell's Alberta oil sands assets back in 2017, and just recently, earlier this year, they purchased Devon Energy's Canadian assets as well. This pushed their production up by about 200,000 barrels a day, and they are a cash flow hog. The company has generated over $6 billion in free cash flows in 2018 compared to Suncor at $5.1 billion and Imperial Oil at $2.8 billion. The company has very strong production. They're capable of producing up to 1.2 billion barrels a day. and they have what I would believe to be the best dividend in the oil and gas industry, excluding pipelines. And we do have a pipeline stock, one of the most popular pipeline stocks, coming up in this video. They have a 5-year dividend growth rate of around 18%, and the dividend makes up only 62% of free cash flows. This is often a more accurate and a safer way to judge a dividend when you're looking at payout ratios. I always like to look at how much of the dividend is being paid out by the company's free cash flows, and that can give you an idea of how healthy it is. Some dividend highlights: they currently yield 3.7% with a payout ratio of 42.82%, and they've grown dividends by 18 years. So we're nearing a multi-decade dividend streak by the company. Analyst estimates: they have a 1-year price target of 42.01, which implies about 7% upside. Out of 24 analysts, 18 rate the company a buy and 6 a strong buy. So out of the 24 analysts covering the company, every single one of them signals that the company is a buy right now. And you could have got in a lot cheaper a couple months ago in the low 30s when the oil and gas market was really taking a hit. The stock price has come up a bit now. I think it trades in the low 40s at the time of filming this video, but I still believe Canadian Natural is a pretty strong buy. They have a forward price to earnings of around 15.23 right now. They're trading at 1.43 times book value. They have a PEG of around 2.11, which again is typical of an income stock. They often go for a premium just because of their dividends. Operating cash flows over the last 12 months is $7.7 billion, and they pay an annual dividend rate of about $1.50. So the third stock we're going to speak about is goeasy Limited, an alternative lender here in Canada. I think that goeasy is one of the strongest growth stocks in the country, and combine that with a rock solid dividend, it's just done wonders for investors in 2019. I think it's gone up around 120% this year. So they've expanded their loan offerings. They've increased the amount of loans, the amount of dollar value loans that they'll give to $15,000 to $30,000 this year, and that is estimated to be an $18 billion market. They have easier lending capability than a Big Five bank. I mean, there's not as strict of regulations that the major banks are forced to play by. They have strong loan book value growth. The company expects loan book value to reach up to $1.1 billion in 2020. And just to get an idea of how big of an expansion that is, it was $526 million in 2017. They have a very fast-growing dividend. In fact, it's essentially set to more than double every 5 years. 21% 5-year annual growth rate. They actually increased their dividend by 37% recently. Highlights: they don't pay a very high yield, 1.79%, but their payout ratio is very low at 24.32, and they are very close to hitting Canadian Dividend Aristocrat status, which is 5 years of straight dividend growth. Now, with a low dividend like this, you're more so buying the company for dividend growth. You want to see the stock appreciate and the dividend grow as a result. Analyst estimates: they have a 1-year target price of $69, implying 3% downside. Out of the 5 analysts, 5 rate the company a strong buy. So I think there's a disconnection between the 1-year target price and the analyst's opinion of the price. I really think that goeasy could be a stock that runs up again in 2019. Hey guys, just want to take a quick break from looking at these stocks and ask you, if you like the video, if you appreciate the content, head down below, like the video, subscribe to the channel. We've got way more videos coming in 2020 just like this. We're going to show you a ton of stocks to buy, a ton of stocks to increase the value of your portfolio, and we're really looking forward to it. All right, let's get back to our fourth stock. The next stock we're going to talk about is Enbridge, trading under the ticker ENB. Enbridge is a pipeline company here in Canada, and in fact, they have massive Canadian exposure. Their mainline network covers over 70% of Canada's pipeline networks. This is a huge moat, essentially. There's not going to be too much competition that could come in and take away Enbridge's revenue. and customers, essentially. They've saw some exponential growth as of late. Net income saw an 1,100% increase over the last 4 years, and its compound annual growth rate on earnings is over 82% over the last 4 years as well. I was lucky enough to get into Enbridge fairly cheap in the low 30s. It trades at the time of this video in the low 50s right now, but I still believe the company is a fairly strong buy. I just had the opportunity to get in when it was very cheap. They have low commodity exposure. It's not like an oil producer that's dependent on the price of oil. Enbridge essentially ships oil. They act like a toll operator. They don't sell it, so they don't really depend on it as much as producers. The producers pay them to ship the oil. They have strong dividend growth as well, 5-year annual dividend growth rate of around 16%, and considering how much this company yields, 6.31% at the time of the video, that's a significant growth rate. Typically when you see companies get yields this high, their dividend rate slows down. They're not increasing it as much because they pay out so much. One thing to note you might spot here is Enbridge's payout ratio of 99%. And typically this would be something that you would have to have a second look at. I mean, you would get a little hesitant with a payout ratio that high, but if you look at the dividend growth streak of 23 years, I mean, they've been increasing dividends for almost 2.5 decades. It's fairly safe to say that they'll continue to do so in the future. Analyst estimates, they have a 1-year price target of around 55.52, and that's implying 7% upside as of today. Out of 16 analysts, 9 rate the company a buy and 7 a hold. Right now, the company trades at about 19.5 times earnings and 1.7 times book value. They have operating cash flows of nearly $10 billion, and their annual dividend rate, forward dividend rate, is around $3.24. Let's get on to our last stock. Our last stock on this list of dividend stocks is Algonquin Power, trading under the ticker AQN. And this is a stock I really regret not owning. I was looking at this stock probably 5 years ago around the high $10 range, and I just kept thinking, it'll dip, but it really hasn't. It's trading in the high 18s right now. And they're a top 5 holding in Canada's biggest utility ETF. XUT is the ETF. They make up 8.1% of the assets. And they're a clean energy producer, which is something that I view very strongly moving forward. I'm bullish on the oil and gas industry, but it's pretty clear that we are headed in a direction of cleaner energy. Depending how long it takes, it could take 20 years, it could take 50 years, but there is no question that companies that focus on hydroelectric, wind, thermal, solar power, they are going to be the companies of the future. They have strong North American exposure. They operate in over 12 states, including Arizona, Texas, and California, which are massive states. And that gives the company strong exposure south of the border as well as up here in Canada. They have a 5-year annual dividend growth rate of around 8%. Its most recent increase topped this actually at 10%. Some highlights, they pay around 4% with a payout ratio of 68. They've raised dividends for 8 years, so they are a Canadian dividend aristocrat, and I would expect them to continue to do so moving forward. They have a 1-year price target of $14.55, which implies 20% downside. I'm actually surprised by this. It might be because the company has run up a little too fast too soon. Out of 12 analysts, 9 rate the company a buy and 3 rate it a hold. At the time, the stock, I will admit the stock is pretty expensive. It's trading at around 27 times forward earnings and 1.6 times book value. Operating cash flows over the last 12 months are around $612 million, and the company pays an annual forward dividend rate of around 74 cents. So that pretty much sums it up with our 5 dividend stocks you need to be looking at moving forward in 2020. I tried to change this list up a bit. I could have named the typical big 5 Canadian players, but I wanted to give you a little bit of variety in terms of dividend growth with GoEasy and a renewable player in Algonquin Utilities. Both of these companies still pay amazing dividends, but they aren't necessarily the highest yielding stocks in the country. But I really think that focusing just on yield isn't what you want to do either. If you got a stock that you want included in our next video, drop it below in the comments. We'll have a look at it. If you didn't like any of these stocks, drop a comment below. Tell us what you think. And again, subscribe to the channel, like the video, share the video. We want to develop content that you want to see. We want to bring you better stocks that'll improve your portfolio. And ultimately, we want to make you a better investor.